Mark Matthew joins us now, and let's say hello and good morning to him. Mark, good morning. How are things?
Very well, thank you. And yourself?
Well, with this kind of a market, at least in India, we are not complaining. That's what I can assure you.
No.
It's interesting that India has managed to bounce back where the trade tariffs were less. But China is where the trouble is. Even though the US administration has indicated that, look, we're ready to talk, but we've not heard something from Chinese so far. Do you think it's a matter of time? Someone would say that the Chinese, if they don't talk, we have a problem on our hands?
Yes, I mean, there was an article in the Wall Street Journal just a few hours ago that was saying the US wants to build a kind of coalition to isolate China. And in its negotiations with other countries, it's going to try to get them to do that. So it's the relationship that is the most negative, I'll put it that way. Now, if you're of the view that the relationship is going to stay this bad, then you wouldn't want to go near China. The market clearly isn't pricing that, otherwise it would be down a lot more. And I think the market is right. I find it hard to believe that the US-China trade relationship will go to zero, which is what it would do if these crazy tariffs that both countries have on each other's goods remain where they are, which is over 100%. So I think the market's right that this is all noise for public consumption, but behind the scenes, it makes sense that they are talking. And what was happening in China before the escalation of the trade war was a very positive story, particularly with their high-end technology starting to make big inroads in the rest of the world, including in India, where BYD announced they're going to build a factory, but the DeepSeek news, etc. So I feel that the US-China relationship, as bad as it looks now, will probably look less bad in a few months' time.
Mark, so do you think the risk-on rally which has come back in last 10 days, it's real? Will it sustain, or ultimately thus also will melt up?
Well, you have to take a view on tariffs, as I said. And so there are two ways of looking at it. One is Trump is serious. He's going to keep the tariffs in place until the US starts manufacturing its own things. And the other is that they are a tool for negotiating better deals. I'm not recommending it, but if you read his 1987 book, The Art of the Deal, he does say, I start very, very high. I keep pushing and pushing to get what I want. And sometimes I don't get what I want, but that's how I negotiate. And so it's one of those two. It's either the tariffs are for real or the negotiating tactic. I think it's probably somewhere in the middle, in the sense that he would like to have more manufacturing onshore. But I think that he must recognize there are certain things that the US won't be able to manufacture itself. And so he's using the tariffs as a tool to get better deals with other countries. And so that's largely what the market is pricing in too. And I think that we've reached maximum bad news on tariffs globally. But the question going forward is how quickly do we get some good news on the tariffs? It is possible that it will be slow. And if that's the case, then the markets will be disappointed.
Mark, so what in this market, to your mind, is looking like expensive or overbought, or an asset where it is time to take some chips off the table? I mean, where would you say it's time to take some chips off the table?
Well, obviously, the things that would look expensive and overbought are the things that have done very well, and nothing is done very well except for gold. And we do like gold, so I wouldn't say sell it. That's the only thing that I could say, you know, has done really, really well this year.
Mark, you've been bullish on India. Do you think the worst of the fall in India is behind us?
Yes, I think that India is a good place to be, and the foreign selling appears to have stopped. The oil price has gone down. The rupee is stable. The March CPI inflation print was the lowest in, I think, 6 years, and so we're looking for 2 more rate cuts from the RBI. And the situation on the ground, I think, is such with ample liquidity that banks are going to pass these rate cuts on to consumers. And I'm hearing anecdotally that the rural consumer is picking up. So if I put all of that together, I'm seeing earnings season over the next 2 weeks that will probably be quite decent. And you know, I don't mean to say blindly follow momentum, but the fact is India is up on the year, and the US is not. And to that extent, it probably is attracting attention from people who are looking to allocate their money to greener pastures. So I put it all together, and I think it's a perfectly good story this year.
Hi, Mark. This is Shrishti also joining in. But Mark, with the rising tariff tensions across as well as the supply chain recalibration, do you think India stands a chance to win with the China plus one strategy? Is there any sector you wish to highlight where you believe that India could be the winner?
I don't know about winner, but the one sector in India that looks interesting to me is the one that's done the worst this year, which is IT. And that's because it's the most exposed to the US economy. And it's down to over 20% since the beginning of the year and trading at over 1 standard deviation below its long-term average price earnings ratio. So if you are of the view, which I am, that we have reached peak bad news on tariffs, then I think that the IT sector in India is a good place to start accumulating.
So let's understand what exactly are markets pricing in on the tariff front. To assume that no tariffs would come would be outright silly. To assume that nothing will be negotiated between US and China, that also looks unlikely. So from a market standpoint, are markets pricing in a middle path?
They must be, because otherwise they'd be down a lot more than they are. The S&P is only down around 8% so far this year, and many markets are up. So if anything, I think that they may be pricing in a scenario which is slightly more positive than what we're going to see, but we really don't know. It's so hard to forecast these things. My own sense is last week, the big move in Treasury yields seemed to have prompted some response from the White House that was a sign they do realize that they are causing some disequilibrium in financial markets, and there are a few economic indicators that came out to suggest not just financial markets, but your average person, consumer surveys, is very, very concerned about the potential for tariffs causing a recession and inflation. The one I'm referring to that came out last week was the University of Michigan's survey for the month of April, which showed inflation expectations went up to the highest they've been since the early 80s, and unemployment expectations also went up to the highest they've been since COVID, I guess. But that's not a situation that one would like to see. And the IMF did a study, and they found that inflation expectations do impact actual inflation in developed markets. A 1 percentage point increase in inflation expectations tends to lead to a 0.8% point increase in actual inflation. So my point is that they should realize, the White House, they are, if they continue this, going to cause a recession. And I think they probably would like to avoid that. So I think they're moderating their stance. And the question is how quickly are we going to get some good news on the tariffs? The next big thing will be to get a bilateral deal announced between the US and some country. My guess is it would be Japan, because Treasury Secretary Scott Bessent has said that should be the first. But Japan or Canada or Mexico, they've been talking to the US for some time now, and that would be positively received.
Since in the near term we are witnessing a lot of volatility, but if someone wants to allocate fresh capital with the next 12 to 18 months investment horizon, help us understand which geographies or asset class will be your top bets at this point in time?
We like Europe, and we like China. They're both big economies that have deep financial markets, and the governments in those countries have the ability to stimulate their economies more than in other countries through both monetary and fiscal policy. And I read a quote, I can't attribute it because I'm sorry, I don't remember who said it, but somebody said that Trump and Putin are the best thing that could have happened to Europe, because they have woken Europe up from its lethargy. And this is happening. The Europeans are kind of getting their act together. The Germans have announced a big stimulus package, an increase in defense spending. Europe is talking about trying to become more collective in the issuance of European bonds, for example. And so we like Europe. China has been such a laggard for the last few years. It's not an expensive market. There are these good stories in its technology sector, as I mentioned earlier. Property prices are still negative, but the trend seems to be towards zero sometime this year in year-on-year change in property prices. And they also have the ability to stimulate. So those are the two that we like right now.
So Mark, hypothetically, if I say, Mark Matthews, you got one trade which has a shelf life of 3 years, and then you can go on your long holiday, but you're allowed to trade once. Which would be that trade for next 3 years?
Well, it's India. I've always felt
I like
that
you.
India's...
Suddenly I like you a lot, Mark. When you say
Yeah, thank you. It is India. I mean, it's in our mind the only emerging market that people should own for the long term. The other ones really haven't worked out, and you can see that if you look back at their historical performance. Almost every emerging market has been a disappointment, whether we're looking over the last 10, 20, or 30 years. And that makes India quite a standout, because it's been a good market to invest in. And I think the reason must be in part the economy of scale of the country is much bigger than, even though Indonesia or say Vietnam or the Philippines have over 100 million people each, still India has 14 times that many. And so there's a vastness of the economies of scale for companies that operate there. As the middle class gets bigger, more money will be allocated to the domestic equity market. Unfortunately, in most other emerging markets, the middle class, believe it or not, is shrinking. It's not getting bigger. And two of those countries I just mentioned, I know for a fact, and Indonesia and the Philippines, their middle class is actually getting smaller in size. So India would be the 3-year view for me.
It is. And on that good note, Mark, we'll let you go. Thanks for your time as always.
If you like this video, then like, share and subscribe to ET Now.